Good evening, everybody. My name is Daniel Young. I'm the owner and founder of Adapted Perspective and the Adapted Perspective social media platforms, and I am back to talk about our stock market strategy utilizing closed-end funds. So to get the normal disclaimers out of the way, this is an unedited video. Who knows what you'll hear in the background as I film these in my house. I'm not a financial advisor. I am a financial strategist, and I don't speak like the herd. I walk in limited company, and sometimes I walk alone. So the quick update is this. Of the three ebooks that I've started writing, two are done. The general strategy is done. The dividend strategy is done. Scholarships and how to use scholarships besides the obvious intention, that's next. And in writing these books and in how I've learned to process information, I don't know, how I've progressed through these books, I realized that I need to change my presentation on these videos. But my goal is to start a private membership where you have access to the master file. And I've said that before. Uh, I've said that a lot. It's very much my intention. I mean it because everything I'm showing you in the videos, the notes, the full closed-end fund list, our portfolios, how the tabs communicate, the recent YouTube snapshots, and our own personal buys would be yours to see and shift, or see yours to see and sift. But a lot of people would ask why. Not many people do that. I only really know one group that shares their buys, but they're not telling you how much they're buying. They're sharing an individual ticker and dividends made on that one share, but they're not actually telling you the size of their portfolio, how many shares total they have, or anything else. So why would I do it? Well, transparency. I mean, I do follow through on what I say, but really, I want to help you. I want to help you have all the data because you need all the data to sift the list for yourself. You need to realize the videos are snapshots. What works one week isn't guaranteed to work the next. You could pull a video from a year ago and listen to it, but the market has shifted since then. We might be targeting the same currents, but we might not necessarily be targeting the same funds. And the snapshots are important, but they age as soon as the next opening bell dings. And three, as much as some of you might want the list, I want to teach you to sift the list for yourself. And it's hard to sift a list that you don't have. I mean, I've been in your seat watching and reading cherry picks and wanting all the data so I could make my own decisions. And while I've been walking you through the system, you're still not in the best place to make the decisions for yourself based on your observations of the market. Maybe you do agree with me and everything I say makes sense. Or maybe these videos help you think, but you pick other funds. But the trouble is, without the complete list, it's hard to pick those other funds. So I want to change how I teach on this platform for your benefit and my own. And to be quite honest, I want to help you, but it doesn't help me to give away the methodology every week while still holding the full intel back. So if you're just here for the snapshots, you'll still get a small Polaroid, but I'm not going to completely develop that film here. I'm going to mentally prepare for hosting membership only sessions where I teach how to find active financial currents and target funds based on those currents. The full narrative, the sift and sort, will happen inside the membership. And that's not to say I want to end these videos. I want to discuss them. I want to discuss all phases. So world view, US view, and then your corner of the market, or the macro, the meso, and the micro data points. That information should shape it shapes our financial investments across the board. And if you can read the signs, you'll find the active financial currents. And in using that term, currents or financial currents, I shared this last week. So the terms that I've developed in the language of my books, financial currents or financial waters, currents, waves, ripples, and tides. Currents exist whether you like it or not, and they're always moving. There are lots of financial currents that are always at play, Some waters move faster. Waves are large events, recessions, wars, policy shocks, herd fear, herd panic. Ripples are smaller disruptions, and then tides are the long term consequences of choices, including your own. So let's shift that terminology and apply it to recent events. In the macro data, the US is the leader in world business, and most everyone wants to be in the American marketplace. Two, we live in a debt riddled world and a debt financed world. Three, this is the dawn of the next technological and AI boom. The metadata, increased reports of waste, fraud, and monetary abuse, as well as attempts to cover up those things across the country. American nationalism is on the rise across the country, and there is an exponential growth in the American economy, and we are poised for even more growth. So the wave fallout. Robert Kiyosaki recently published he published a post on Facebook. So he exposed the hidden narrative behind President Trump's instructions to Fannie Mae and Freddie Mac about those two groups buying mortgage-backed securities. So we'll say Kiyosaki's feedback was this: you don't need the Federal Reserve to move rates or influence mortgage rates. If Fannie and Freddie use their current cash hoards to buy mortgage-backed securities, the rates could fall. Now, they're not printing money like the Fed. They're not producing new money. They're not honestly stealing money from anywhere else. They're using money they have on hand that's just sitting there, and they have billions of dollars. So if you think of it like a recycling system for money, Fannie and Freddie could buy mortgage bundles, and the government ensures banks always have fresh cash to lend out, which theoretically keeps the price of borrowing or the mortgage rate lower than it would be otherwise. And think of how to say this well. The current chair of the Fed, Jerome Powell, has proven that he is consistently behind the curve, meaning he's perfectly happy being slow on the curve or being behind the pace of the curve. He's proven that, unless it's an election year. So in his slow roll of cutting rates, the next chair, regardless of new chair it would be, the next chair said he wants to cut rates for different reasons, but he wants to cut rates. They don't want to be behind the curve anymore. So with an expanding GDP, with an expanding economy, and with lowering inflation, the Fed should cut rates, but they're not. So the Fed sets the national rate. That rate affects everything else: car loans, credit card, house loans, everything. But instead of waiting for the Fed to act, Fannie and Freddie could go around the Fed by buying bundles of mortgages and lower the rate. And then when the Fed finally catches up and lowers the rate, it would drop the rate more. So switching from that, the other wave, or at least the other wave I want to talk about, is tariffs. All of the experts were wrong about tariffs, which makes them wrong about a lot of other things if you think about it. And the only right decision or right thing they actually do is predicting doom and gloom, because fear sells and panic sells. The market shifts on headlines. So when the news or the teleprompter jockeys push these headlines and sell doom and gloom, the market reacts to the headlines. Why? Because the herd is in the market, and the herd swings the market. So it's not that the headlines swing the market, the headline swings the herd that then swings the market. And they push fear and doom and gloom. Why? Because it sells, and it's an attention grabber. It's like the wreck on the side of the road. You're driving, I'm driving. I really can't pay attention to it because I'm driving. Otherwise, I'll end up as the next wreck on the side of the road. but everybody else stops to see the wreck. Why? Because you can't help but look. It's the same thing. So the experts, the supposed experts, were wrong about tariffs. How wrong? Well, the US is taking in so much tariff money that President Trump, again, he refloated the idea of no personal taxes for anyone and for tariff money to supply the US budget. Now think about that. I mean, seriously, think about that. How much money would that put in your pocket? And now the microdata. Have you seen any ripples in your area? Have any of the national developments caused any progress in your area? In my area, gas prices are down, grocery prices are down a little, and home insurance prices might be neutral on the year. Now, how do I get that data? Well, the property premium on our investment property actually came in and it went down $50, which is amazing. I mean, it hasn't been net neutral since we bought the place. So if that would carry over to my personal residence, that would be amazing, but we'll see. So let's see. Currents, we've kind of talked about. Waves, ripples, tides are the fallout of every decision. Yours, yes, but it's also the fallout of all of those other decisions. So what might be a ripple to you might be a wave to somebody else. But the tides are the fallouts. You make your choice and act, and then you ride the tide until it's time to move. So where does that leave us? Well, we're still in, or we're still chasing the same currents: bonds and bonds proxies, end-to-end energy, and technology beyond the giants. Now, I'm not saying to ignore the giants, but we should include others. So those remain the best places for us. 2026 is poised to be another bond bull, and that bull will pull the proxies with it, especially following the call to Fannie and Freddie and the new leadership coming inside the Federal Reserve. Now, regardless of market, regardless of current, the strategy is to scoop deals in the present market, buying with the future market in mind. So while the herd continues to chase isolated reflections in yesterday's market, we're moving in the current, and the current is carrying us beyond those isolated locations from the market's past. So let's look at the snapshots. Now, I'm going to offer you a snapshot and not sift and sort like normal. I'm going to sift it a little bit, but not like normal, to maybe a handful of funds. Let me share my screen. So this is the initial snapshot, all sorted like normal. Like I update the closed end fund master monthly. I update it, or I update these asterisk funds weekly, and then weekly I offer a sifted list of asterisk funds of top targets on my radar for this week. So based on the top three currents: bonds and bonds proxies, end-to-end energy, and technology beyond the big guys. So BRW, as they are labeled. I'm not going to read it all to you. The stuff in blue we've already talked about at length. The new one on the list is this one. It's a recently listed closed-end fund back in December. There's three current recently listed closed-end funds, but this is the only one to make the list. It's an interesting proposal in that, so HFRO does some private equity, some private real estate. This one is the only fund to target only private institutional real estate. I mean, honestly, that's interesting. Interesting enough for me to research it and pull it up. So generally, when funds debut, they start at a price, they drop, and then they rise back up. Not this one. It's actually risen since it listed. The NAV has stayed the same, but its overall price has risen, which means the discount window's closed a little bit. That's interesting. Here's the breakdown. Now, remember initially, you have the US is the number one market space. You have the onboarding of both domestic and international wealth or more capital pouring into the US in order to manufacture more goods, etc. That's great for the industrial market space. HFRO is a great resident. They've actually changed the portfolio. So HFRO's portfolio is now real estate, medical real estate, and individual medical research companies. They've got private storage, like rentable homes, single family residential, but not a lot of industrial space in this magnitude. Um, so it's interesting in that regard. It's also interesting uh, with what we've already talked about. So with lowering rates, with Fannie Mae and Freddie Mac maybe trying to influence the overall mortgage rate, all of that's promising for this industrial for this specific private investment real estate group who's got a huge amount of investment in the industrial real estate market. So that's interesting. My hesitations are these. So generally, the closed-end fund investor group is highly skittish. They want to see something succeed for a while. Now, you could argue it was a privately held firm that turned into a closed-end fund. They've been around for a while, et cetera, et cetera. But generally, closed-end fund investors are hesitant to buy anything new. Two, it's a little toppy in the sense of it's pushing the end of my range. Like my range stops at 16. I really don't like buying over that. I've made one exception to that recently, and I've been happy with it, ADX. But it still sits towards the top of my range. This, the dividend is inconsistent based on this dividend, right? 134 a share a year boils down to 0.1116 a year. That's quite different than 37 cents a month. So I don't know what the actual dividend is, and I would like to know before I buy. And the third is it's a the headquarters of the company are based in New York, and New Yorkers are leaving New York City in droves. So I don't know how the overall situation for New York. I'd have to go back and dig into the actual physical location of the company. Yeah, it's on a different one. I have to dig into the actual physical location of the company because if it's based in New York City, with the way New York City is angling, I don't know how that would affect the fund. Now, sure, they could move. I mean, I'm sure they're protected from increased taxes. I'm sure they are. But at the same time, altogether, it's an unsure buy for me. And I get it, like 35% off. That's like paying 65 cents on the dollar. That's a really good deal. And it's an interesting thing to consider for the future, but it's not going to make my list this week. So that leaves stuff that I already own, that we already own, and what we recently bought for the most part. Like we bought last week. I bought BRW and FSCO in the cash brokerage, and then I bought BRW and FSCO plus PDO in the Roth. And for us, that's the best move. It's hard to justify picking up a new company and paying almost twice of what I would pay here, even though they have an interesting portfolio. That being said, I'm not buying, well, nobody's buying on Monday. I'm not going to buy Tuesday. So we're just going to hang out and sit and see what the market does. But if I were buying, what would I pick? And I ran over this before I made the video. It all comes down to how you think the market will move. All of these are great deals. They're all great discounts, right? And pending your payout schedule, we've talked about that at length. If you think that equity stocks are down and that for whatever reason blue chips are down right now, equity growth stocks, however you want to define it, if you think they're down right now and you think growth stocks, equity stocks, which all of these are growth and equity stocks, it really just depends on how you define it. But if you think that tech and blue chips are going to just take off, then that leans more towards USA and ASG. And I get ASG doesn't have a 9% dividend, but if you factor them in together, because I like buying those two in sets. Like I like buying 100 of one and 100 of the other. I like buying them in pairs, I guess you could say. Then together they have more than a 9% dividend. You could argue for the same thing for HFRO and HGLB. I know I've talked against buying more HGLB, but the more I look into their portfolio, the more interesting it gets. They've changed. It's still a significant portion of their portfolio in the mid-wave wireless. They've also added new data centers, new software centers. They've got some real estate interest as well. Or yeah, I'll say that they've got some real estate interest as well. So and utilities. So that's interesting. But just on sheer value and overall discount and yield, the top two are unchanged. BRW bonds, FSCO is bonds, and a BDC. And BRW is kind of international. FSCO is an all-American company. So for an all-American outlook with America taking over the market space and with more people wanting to be in America and the growing economy and that middle group of small businesses needing more capital, FSCO is well prepared, well primed to just do well the next 4 years. So what would I pick? Well, I'm not buying tomorrow. We just bought last week. And even though we just bought the same, I would pick the top two. If USA and ASG were the best things on the list, then I would pick those. It's hard to look like they pay great, but they do pay they their price pattern is cyclical in the sense it just goes up and down. Um, and it like they pay well, they're cyclical funds. You can buy, sell, like whatever your strategy, but it's hard for me to buy a quarterly fund when I can get a monthly dividend. So for me, the top two are BRW and FSCO. But quite honestly, I would do the same thing instead of buying USA and ASG with Power, which I get it. Like growth stocks, equity stocks are down, but that's really the whole list. I would do a little bit of the same with HGLB and HFRO. I get that it doesn't meet the yield threshold because the goal is 9%, but it's still a 46% off discount. So it's like paying 54 cents on the dollar instead of a dollar. So it really depends on your overall belief system of the market. I would pick the top two. These are a close second. And if you just wanted blue chips and technology, then it's those two. So take it for what you will. Maybe not a handful, maybe a little bit bigger than a handful, but that's the snapshot for the week. So think of how to say this. It's not quite where do we go from here. I want to keep making videos. I want to keep talking about the market and the changes and the macro data and how all of that filters into the snapshots. But I do need to somewhat set some different boundaries for myself because one, I can teach and explain and expound and make really long videos. But I really do want to create a membership list. It's been on my to-do list since I started these videos. And I finally see a pathway towards making that happen. So on my end, that's a lot of progress. There's other stuff going on. And it's not like I've procrastinated that decision. It's just that I couldn't figure it out. And I finally seem to be, I don't know about headed in the direction, but I finally have some framework of how I want to do that. Which honestly really stems from me finally sitting down to write books because it makes me think about process. And in doing that, it really helps streamline my thought, but it makes me think about how I want to do things. So it helps clear my thoughts. So last week, made some great progress. I've got some stuff lined up this week. We're going to see how well that works out. Um, we all have plans, and sometimes those plans go awry. So we'll see what happens. I'm hopeful of having a productive week. Whatever you have going on, I wish you a productive week, and I look forward to our next chat. I will maybe not go back to the full drawing board, but I will hopefully start work on a new book this week. And when they're all said and done, I look forward to sharing the material with you. So I wish you a great week. I will see you later. Bye bye.